Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. Welcome to our webinar this morning, where we're going to find out more about what's happening in Asia and what's happening in Asian share markets. We're absolutely thrilled to have Mary Manning, Portfolio Manager of Ellerston Asian Investments, joining us this morning. I'll introduce Mary in a moment. Firstly, a warm welcome to our GFM clients, particularly our clients in Melbourne during stage 4 COVID restrictions. We know it's not easy at the moment. We hope you're well, you're staying safe, and hopefully we're now starting to see light at the end of the tunnel. And for our guests that have joined us this morning, thank you for dialing into this webinar. We hope you enjoy the session. Now, as long-term clients of GFM would know, we're a very social business. We run lots of face-to-face events. In the absence of being able to run these face-to-face events, we are running these series of webinars which have proved very popular, and particularly our attendance rate for today's webinar is particularly high. Now, before I get underway with this webinar, it's important to acknowledge that today's webinar is general in nature. We're not providing any specific advice. If there's anything that you have heard in today's webinar that you feel like you'd need clarification on or you'd like to discuss, please contact our office and one of our advisors will be in touch with you to assist with that query. It's certainly eventful times in Asia at the moment, and particularly in China, so it's going to be fascinating to hear what Mary's got to say. And in fact, prior to today's webinar, we asked the attendees if they had any questions. Again, this proved very popular. We had lots of people that wanted questions asked. We're going to do our best over the next 45 minutes to answer those questions. But if we don't cover something that you did ask, our apologies in advance. This has proven to be a very popular topic and quite topical to the news at the moment. Now, I'll formally introduce Mary and we'll get underway with the questions. As I alluded before, Mary is the Portfolio Manager of Ellerston Asia Investments, but she's also the manager of the Ellerston Asia Growth Fund and Ellerston India Fund. Mary has over 17 years experience in funds management. She joined Ellerston in 2012. Back to 1997, Mary worked with Oaktree Capital, both in New York and Singapore. So Mary has a PhD in economics from the University of Sydney, an MBA from Harvard Business School, which is incredibly impressive, and a Bachelor of Commerce degree from the University of Calgary in Canada. So good morning, Mary. It's great to have you on board.
Thank you so much for having me, and hello to all the GFM clients. I hope you're well, particularly those of you who are in Melbourne. Thanks for having me.
Thanks, Mary. Mary, I guess the first thing I'd like to talk about is what's talked about a lot, and that's this structural growth opportunity of Asia and particularly China.
Yeah. Okay, great. It's a great question to start off with, because actually when I started Ellerston Asian Investments, when I went into Ashok, that's our chairman's office, and said, I think we should have an Asia fund, the first bullet point on my presentation was because Asia is a good growth story. In fact, it's not just a good growth story. In my view, it's the best long-term structural growth story in the world. So just so that your clients have an idea of what this means when I say structural growth story, it's important to differentiate between structural growth and cyclical growth. So cyclical growth is, there's expansionary fiscal policy or zero interest rates or some sort of policy initiative that provides short-term cyclical growth. So structural growth is the kind of growth that happens regardless of what's going on with policies and different business cycles. So Asia has a lot of building blocks. I think you can see the slide that's in front of you that create this structural growth story. And the first one that is very important is demographics. So Asia, just in China and India alone, there's 2.5 billion people. And, in India, there's over 400 million millennials just in India. And when you look at demographically what that implies over the next, 10, 20 years, as those people enter into the prime, consumption and investment parts of their life cycle, it's very, very attractive in terms of creating investments. So demographics is one. Rising middle class is also important. If you look at a lot of countries, when people buy their first home and their first car or their first two-wheeler, or they go from shopping in informal markets to shopping in shopping malls, all that kind of stuff can be played via the stocks that are available in these countries. Technological leapfrogging is something that I've been witnessing for a long time. As you mentioned at the beginning, I started working in Asia in 1997, but it's really come to the fore because of COVID, because everybody in the world is technological leapfrogging, and in Asia and some of the developing countries in the world, this is even more important. So what this means is instead of like in Australia where you had many decades of a huge build out of retail shopping mall infrastructure. In Asia, people may go primarily just to e-commerce. Or when you had a huge build out of landlines and fiber in developing countries, in Asia, you've already seen people just go straight to mobiles. So that is also a driver of structural growth. Infrastructure in many Asian countries, particularly the less developed ones, is far below what it is in developed markets. And that's a way you can play that via investments, but more importantly, as infrastructure improves, it adds to productivity of the economy, which drives GDP growth. Capital market development. This is really important, particularly in China. Just in the time since Ellerston Asian Investments has listed, you have seen, the launch of Hong Kong, China, the Stock Connect, which is, a huge sort of pipeline of investment that can go from Hong Kong to China. You've seen the launch of many different markets. You've seen volumes in a lot of these markets in Asia, double or triple in the last few years. So this is a really positive thing for investors because it means that there's liquidity there when it wasn't there before. And then lastly, policy optionality. Those other boxes are all structural growth. And, Asia, unlike a lot of developed markets, where there's not that much room to move on fiscal after what they've already done on COVID, and most developed markets are at or near the zero bound in terms of interest rates. There's not a lot of policy optionality if things go wrong from here in developed markets. Whereas in Asia, there's not one country that's on the zero bound in interest rates, and many Asian countries still have room to move on fiscal policy or on FX or industrial policy. So that growth story is definitely still intact. And the good news is that sort of structural growth for GDP and whole economies is translating into EPS growth for the companies, and those are the kind of companies that we want to invest in.
Fascinating. So with this structural growth that is occurring in Asia, we've also seen the emergence of some very, very large businesses out of Asia. Do you want to, and I don't think this is really well known, Mary, the size of these Asian businesses now. Are you able to talk a little bit more about some of these Asian mega cap businesses that have emerged?
Yes, absolutely. So a lot of people are very surprised when I say that the average market cap of Ellerston Asian Investments is over 200 billion. And people say, whoa, I didn't really think there were that many companies at all in Asia that had market cap of 200 billion. How can you have a whole portfolio where that's the average? And so, as you mentioned, a lot of this has to do with the rise of some of these mega cap companies in the last few years. And not dissimilar to what we've seen in the US, they are, concentrated in the technology space. So if you look at the table on the left-hand side there, you can see that of the top 7 largest companies in the world, according to the MSCI All Country World, you have the ones that everybody knows about: Apple, Microsoft, Amazon, Google, and Facebook. And then you have 2 Chinese companies. So if you had said to people even 5-10 years ago that in the top 7 companies in the world there's going to be 2 Chinese companies, I don't think people would have believed that. But these Alibaba and Tencent in particular, they have not just structural growth stories, they have structural growth ecosystems. So if any of you are on WeChat yourselves, or you have Chinese friends who use WeChat, once you're in the Tencent ecosystem, there's so much opportunity for cross-selling, and Tencent is going into industrial internet, and they have a payment system. Alibaba is the same. It's started primarily as e-commerce, but now they have Alipay and they have AliCloud, and they're IPOing Ant Financial, which in itself is going to have a market cap of 250 billion. So those sort of ecosystem stocks in China are getting to be huge. One other thing I'll mention about those while we're talking about it is you do see in some global funds now that Alibaba and Tencent are starting to pop up. And that's fair enough. If you're a global fund, especially if your benchmark is MSCI All Country World and not MSCI World, which those companies are not big weights in that. But they're big companies in the world, so it's fair that they pop up. But I've had some investors say to me, well, I don't need to own an Asia fund because I own Alibaba and Tencent in my global fund. But if any of the people on the call are thinking that way, I would challenge you to look at what percentage of those companies you own in a global fund, because in Ellerston Asia, we have about 18% of the fund is in Alibaba and Tencent. So those are very, very big concentrated bets on those 2 best companies. And the second thing I'll highlight is that at Ellerston, we participated in the Alibaba IPO, which was, I can't remember when it was, like 8 years ago, no, 6 years ago now. And, our entry price for Tencent was around $100. So it's now at, over $500. So, when these big global funds, you didn't hear anything about their love of Tencent when it was 100. They didn't say anything at 200, nothing at 300, nothing at 400. Now it's up near 500. Now it's in their top 10 and they are making a big deal about it. But I think, if you want exposure to some of these mega cap companies in Asia, I think it's important to do it through an Asia fund. A, because you'll have more exposure and more direct exposure. And secondly, because an Asian dedicated fund manager is going to potentially identify those mega cap companies before they're in the top 10 biggest companies in the world. So moving back to your original question about the rise of these mega caps, it is focused on tech, but there are a lot of non-tech companies or names that are not potentially household names, which are also massive companies in Asia. So TSMC is a Taiwanese company which makes semiconductors and makes chips. That's almost 400 billion. Maotai is a white liquor company in China, which is now 287 billion. Samsung, everybody knows about. Meituan is a company which just listed maybe 2 years ago. It's already a $200 billion company. Ping An is an insurance company, also almost 200 billion. And then Reliance and TCS are Indian companies. And this really shocks people because they think of India as sort of they know there's lots of people there and the growth pre-COVID was very fast, but they don't think of it as a market where there's mega cap companies. But Reliance has just secured Facebook and Google as investors, and TCS and Infosys. These are mega cap companies which are operating globally. So it's quite interesting. I just encourage you to think of Asia not as a place where there's sort of these niche businesses where maybe you're getting some growth, but a place that is home to mega cap companies, and it's going to be increasingly home to those companies which are going up the mega cap curve.
Yeah, fascinating again, Mary. Mary, when talking about Asia, it's hard not to focus on China, and it's also hard not to be, not to see or hear the news where we hear about a large amount of debt in China. There's stats like 300% of GDP. We hear about non-performing loans. We hear about the shadow banking system and defaults. Is this potentially a risk to growth for the Asia region, and particularly China, going forward?
So it is a risk, but it's not a risk that I lose sleep about at all. So it has been that part of it is just the structure of the Chinese economy and the structure of the Chinese banking system. And so, I have been doing this for a long time. And before I was a portfolio manager, I was a financials analyst. So I was covering the Chinese banks when most of them IPO'd in 2004, 2005. And at the time, the biggest pushback that they got for IPOing these Chinese banks was exactly what you just said. There's high debt levels. We don't trust the NPLs. They lend to zombie companies. There's shadow banking. And, that was 15 plus years ago. And that has never sort of come out as a risk for investors. So, it may be a long-term risk, but it's not a reason not to invest. The second thing I'll highlight is that people need to be careful in terms of comparing debt statistics country versus country. So China, the debt to GDP number, a lot of that debt is in the Chinese SOE companies, and it's not at all at a personal level. So actually Chinese people, their savings rate is very high, and the personal, debt to household income ratio is actually very low. And so if you look, over the course of history, or certainly over modern history, when there are sort of unwinds, it is much more messy typically when you have an unwind in consumer credit than when you have an unwind in like SOE credit. And the reason is, in China, people often make the comment that it's a closed loop. So you have SOE companies that are owned by the government who are given loans by banks that are also owned by the government with debt, and then you have the Chinese government, which is also a source of debt financing. So that's all a closed loop. The chances of that getting messy are much, much less than, say, the GFC, where you had, like Lehman Brothers and a lot of these, mortgage-backed securities, and they were issued to individuals, or even, frankly speaking, if you ask me, what are you more worried about? The debt at the household level in Australia or the debt overall in China? I would say the debt at the household level in Australia, because those sorts of unwinds it's not a closed loop and they can be quite messy. So that said, in our portfolio, just so you and your clients know, our portfolio in China, we own one Chinese bank, but it is by far the highest quality and the highest growth one. Other than that, all of our companies are generally new economy companies. So that's either consumer or technology oriented. We own one cement company, but on average, our Chinese companies have net cash balances. So we do not take any risk in terms of corporate balance sheets, and SOEs in general are not a place in China where we like to participate.
Mary, as you'd probably appreciate, a lot of the questions that we had prior to today's webinar was around the geopolitical environment in Asia, particularly, again, China. You know, we've got frosty, and I'm probably using a tame word, a relatively frosty relationship between the US and China at the moment. We see what's happening in Hong Kong. We hear about the South China Sea. There's Taiwan. There's the regulation of these technology companies like TikTok and WeChat. Yep. This geopolitical relationship between the US and China has got very busy very quickly. Could you work us through some of those issues?
Okay, so you're right. There are a lot of issues here. And actually, one thing I'd just like to say is I really appreciate the fact that yourself and Patrick have been so proactive and on the ball in terms of contacting me to get views on Asia as this situation has evolved. Because I remember, I think we had a call right in March, maybe very beginning of April, to talk about COVID in general, but you asked the question about geopolitical and we had a long discussion about that. Then at our next conference call, we picked up that discussion. So I really appreciate it that you guys are so on the ball in terms of having views about this and knowing the questions to ask, because it's a credit to your clients that you're so proactive about understanding this. So thank you for that. Yeah, there were a lot of questions involved in your questions, so I'll try to tackle each one of them in turn. So my view has been for a long time, as in like since Trump was elected almost 4 years ago, that the US and China relationship is on a deteriorating path, and that this is not a one-time sort of thing. This is something that as an investor in Asia and an investor in China is the new normal, and I'm just going to have to learn to live with it and invest in it. So the reasons are, when Trump first came in, it was all about trade and a lot of anti-China sentiment around trade. And me and my team, our view has always been that this is not about trade. This is about hegemonic decline of America and the rise of China as its major competitor. And so that overall overriding dynamic is going to seep out in many different ways. And so that some of the things you mentioned before are just the ways that those are seeping out, whether it's South China Seas or banning of TikTok or some of the other things that are happening. So we've identified these 4 flashpoints, which is what you can see on the presentation, which is where we think the most likely ways that this deterioration in the relationship is going to play out. So the first is Hong Kong, and as many of you know, the national security law was imposed a few months ago, and this has created a lot of issues, and so now there's back and forth with applying sanctions on U.S. officials, and then China, or the U.S. has applied sanctions on Hong Kong or Chinese officials that were involved in the implication of the national security law. It's very tricky for U.S. companies who are operating in Hong Kong right now, particularly banks, whether if they bank with police officers or carry lamb or something like that, they can be sanctioned. And so Hong Kong is sort of a geographical flashpoint for the U.S.-China relations. The other thing, we're going to have to add another row soon, because I actually think that Taiwan is going to become a flashpoint also. So you can see now in terms of the buildup with South China Seas, you can see the U.S. sort of nettling China in terms of sending senior officials to Taiwan, and it seems like they're moving along the path to recognize Taiwan with more autonomy. I think that that's going to become an increasingly big flashpoint over the next, say, 5 to 10 years. So that's sort of one flashpoint. The second one is technology, and this is one which is dear to our hearts because, as I mentioned before, we have about over 45% of the portfolio is in technology or technology-related companies. So this, it kind of started with the crackdown on Huawei and ZTE. Huawei, everybody's heard the news about that. In our portfolio, we have dealt with that by just not being exposed to the Huawei supply chain at all. There's a thing called the Entity List and Department of Defense list, where we are very careful about what companies we own in China in the tech space, because the US can wake up one morning and stick one of those companies on the Entity List, and then US companies can't do business with it. And then the last one is banning of Chinese apps. So TikTok and WeChat a few weeks ago, there was an executive order issued by Donald Trump about banning TikTok and WeChat. We have a major position in Tencent, so obviously this was something we were watching closely. If you run the model on Tencent, the banning of TikTok, or sorry, the banning of WeChat doesn't actually make any difference to revenues. It's like less than 1% of revenues. But Tencent also has a lot of investments in the U.S. in everything from Tesla to gaming companies to those sorts of listed companies. And our concern is that the banning of WeChat could be just a first step moving on towards the banning of investments. So that's why we're a little bit wary, and we have a smaller position in Tencent than we have in the past. But technology, I think of these 4 flashpoints, technology is going to be the biggest one. Capital markets, you've probably heard the news about crackdown on ADRs. So some Chinese senators and the SEC are trying to make more rules for auditing of ADRs. And if they can't meet these new audit requirements, they're going to get kicked out of the U.S. capital markets and have to just list in Hong Kong. So Chinese companies get this, and you've already seen major relistings in Hong Kong, Alibaba, NetEase, JD. So we expect that will continue to happen, and that's why we have a massive position in Hong Kong Exchange, because we think that will continue to happen. And then lastly, trade has sort of taken a back seat versus where it was maybe 2 years ago, but that's going to continue to sort of muddle along, and you'll see when it's politically expedient for Trump or whoever comes after him to use trade as a way to get back at China, that will be used. I guess one other comment I'll make I'll make 2 other comments on geopolitics. One is we're getting a lot of questions of what happens in November and who is going to be better for China or for Asia, Trump or Biden. And the answer is a little bit nuanced. I think in the short term, Biden would probably be better. It would be better for investors because we wouldn't have to deal with all these tweets and all the noise and everything that comes out of the Trump administration. It would be more rational. It would be easier to make investment decisions based on rational policy than random policy. But something interesting we've heard from on the ground in China is that there are a lot of people within the Chinese Communist Party that may actually prefer a second term for Trump, which sounds strange, right? But if you look at the amount of damage that Trump has done to America's standing in the world in the last 4 years, and the way a lot of allies have been neglected or pushed away, in terms of China's long-term goal of that American hegemonic decline and the rise of China, a second term for Trump could actually help that, because America will go down faster and China be able to continue on the same sort of trajectory. So that's sort of, we are positioned to be able to invest regardless of who's president, but those are sort of some of the things that we're thinking about. And then the last point I'll make about geopolitics is that it's not just a deterioration between the US and China. As everybody knows, there's a marked deterioration in the relationship between Australia and China. And so this is one thing that I personally am finding a bit frustrating, is that people say to me, oh, I don't want to invest in Asia right now because, the US and China, there's some friction there, but they're happy to keep investing in the US. And I say, well, do you own BHP? Oh, yeah, huge position in BHP. Do you own A2 Milk? Yep. Do you own Sydney Airport? Yep. There's all these, do you own Treasury Wines? There are all these domestic stocks, which if China really wants to, and my gut sort of says that the Australia-China relationship is going to deteriorate meaningfully also, there's a lot of risk in Australian stocks. So I guess I would just challenge your clients to think about those geopolitical risks in all portfolios, and not just put Asia in a box and be like, it's all too scary because of geopolitical risk. There's a lot of geopolitical risk around the world, and that needs to be measured with the same measuring stick, regardless of the geography.
So, I read an article the other day, Mary, and it read nasty. The author was virtually saying that there was a possibility that you could see economic ties between China and the US evaporate. Could you see it getting that severe?
Okay, it's interesting. My team and I did a study about this about 2 years ago, sort of on this exact point. And what we came up with was the time for evaporation of ties was about 20 years ago. So by now, the two economies are so integrated that there can be decoupling, there can be fraying of those ties on the edges. But to completely evaporate, I think is economically and logistically unrealistic. So I'll give you some examples. We were looking primarily at the technology supply chain, and really it is so integrated into not just China, but China and Taiwan and Korea and and increasingly Vietnam, that to sort of decouple that now is almost impossible. On the margin, you can take for lower, not lower quality, but less sophisticated products, you can take it out of China and move to Vietnam, and that has already happened in some low-end tech, in textiles, in sort of basic manufacturing. That's already happened. You've seen in India, one interesting thing that we've noted is that some US companies and global companies are doing manufacturing for the Indian market in India, and that's being heavily promoted by the Modi government. So you can see that sort of on the margin decoupling, but really I think that the economic ties are too tight. The other statistic that I'll give you is that I was reading a report this morning from the US Chamber of Commerce in Shanghai, and they asked respondents, how many of you are intending to stay in China, with everything that's going on? And it was 92%. And then they asked people, how, do you think that this is a short-term thing or a medium-term thing? And a quarter of the respondents said they think that this is the new normal, this is indefinite, that this sort of relationship between the US and China is going on. So I think that tells you that China is a huge market for some of the biggest American companies, whether it's Nike or Apple or Starbucks, I mean, you name it. China is their biggest one of their biggest markets, and it's definitely their biggest source of growth. So they're not going to pull out. On the supply chain, across, technology and a lot of consumer goods, it's too integrated to go anywhere. So when you add that up, I think evaporate is unlikely.
What about the, clearly the environment of COVID at the moment? What about the environment in Asia for COVID? India, particularly at the moment, the numbers don't look great.
Yeah. I'll just be frank about it. India's terrible. It's a complete disaster. So India, just so people know, right now they're running between 70 and 80, some days over 80,000 cases. And so, for us, when we hear, no offense, but Dan Andrews talking about 5 cases before people can go out, it's just so dissociated from what we're hearing on the ground in India. And India, it's really unfortunate because the 3 top countries now in the world are the US in terms of cases, the US, India, and Brazil. But of those 3, India was the only one that actually did a proper lockdown at the beginning. Like really early in March, they went into full stage 4 sort of lockdown, and it didn't work. And so we did some work in looking into, like what happened. And there's some evidence that in lower income countries, lockdowns just don't work because it's, I'm still working at home. I know a lot of people in Australia are still at home, and we have office jobs, and it's, I just packed up my screens and came home, and it was completely seamless. But if you're in a very low income country like India, we've heard the same thing from Indonesia and Philippines, and you have no savings and you're making, $2 a day, you can't just, work from home for extended periods of time. So those people just went out and defied lockdowns because it was a decision between, defying the lockdown and having something to eat. And so that has meant that lockdowns haven't worked particularly well in certain low-income countries. So India, I guess the other thing is that I do have an Indian analyst, Vinay, who focuses just on India. He has a lot of amazing on-the-ground contacts. And the view is sort of like, this is going to be something that we have to learn to live with. Mm-hmm. So, I personally think that that's not the right attitude, but people are just going out and resuming life as normal. You've seen a lot of the economic indicators rebound quite quickly. So, that's a concern. That's a concern for us in terms of when are we going to travel there again. Even after the travel bans are lifted, I'm not expecting to go to India anytime in the next few years. But all that negativity said, outside of India, Indonesia, and Philippines, Asia has actually done a very good job of managing COVID. So right at the beginning, I think in one of our early calls, we discussed this also, Paul and Patrick, that we are taking a FIFO view of COVID. So first in, first out. Countries that were the first in and that did a good job of managing it would be the first out, both epidemiologically and economically. So our 3 FIFO countries in Asia are China, Korea, and Taiwan. They all were very among the first countries in the world to start experiencing COVID. And they did a good job of lockdowns, particularly Taiwan, and they've come out the other side. So our portfolio right now is much better weighted, or much higher weighted to North Asia than it is to India and ASEAN. And that's a bit of a change for us. Usually we have more India and ASEAN because they're higher growth economies. And as I said at the very beginning, we are a growth fund and we're looking for growth. But right now it's very, very heavily North Asia focused.
So talking about growth, I'm fascinated to know how do Asian valuations compare to developed markets like the US and Australia?
Yeah. So if you look just based on PEs, yeah, I think you can see in the chart here, Asia is much less expensive. This is, sorry, the chart on the left-hand side is actually price to book. But if you look at PEs, Asia is always cheaper. And right now, Asian markets are at 12, 13 times, whereas US markets are at, 20, 21 times. So this is a massive multiple. But, this is what's frustrating for me is it's not just the multiples different, but that, the growth outlook is different. So we look at something called the PEG ratio, which is the PE divided by the growth rate. And generally, we are looking for stocks and markets that are trading at a PEG of around 1. So say you have Tencent that's growing at 25% and it's trading at 25 times. That's a one times PEG, and we're happy to own that. What we're not looking for are stocks that are trading at 7 times PE and have 0 growth or have 1% growth. Then you're paying 7 times PEG for that. So we look at PEG ratios, and when you look at PEG ratios in the world, that's even more messed up in terms of valuation. You have, it's a bit tricky to look at PEs and PEGs right now because everything is so volatile because of COVID. So you either have to go back and look at 2019 calendar year, or you have to look way ahead to, sort of 2022. But prior to all the COVID noise getting into numbers, Australia was trading around a PEG of around 3 or 4 times. The US was trading around 3 times, and my portfolio was around 1 times. Huh. If you look at both valuations and the price that you're paying per unit of growth, Asia is way cheaper. That chart on the left-hand side, we are looking more at price to book multiples these days than PE because of all that COVID volatility that's in there. And so even you can see on a price to book basis, I mean, NASDAQ is almost at 5 and Hong Kong and Korea are at 1. So there are massive differentials in valuations. And I think, one of the bigger questions is when is this differential going to close? Because I've been doing emerging markets for, 20 years and they're always cheaper. So when is this going to, when are these valuations going to converge?
Yeah. Well, this is fascinating because you're investing in a region of the world that has this structural growth tailwind, yeah, and you're buying at valuations which don't seem to be anywhere near as challenging as other regions around the world. So, I use my term carefully, but this sort of looks like a valuation arbitrage. So, I guess the question is, why is this? Is this because of a lack of investor understanding or a perceived risk of investing in Asia?
So I think it's two things, or this is what I think, and this is also what I hope. So Ashok Jacob, who's the chairman of Ellerston, has a famous saying that he said to some analysts during the GFC that hope is for losers, because somebody asked him, he asked this analyst, what's going to happen with this stock? And he said, well, I hope this is what is going to happen. He said, I don't want to know what you hope. I want to know what's actually going to happen. So I will couch this by saying, this is what I actually think will happen, but it's also what I hope happens, because this, like you say, this arbitrage has been going on for a long time now, and it's, it sort of needs to be addressed. So there's two things that I think will happen. One is, since the GFC, you have had structural growth in pockets of developed markets, so that people who invest solely in these markets have had options other than going to emerging markets in Asia to get growth. And that the biggest and most obvious pocket is obviously tech in the US. So people say, yeah, I know there's, financials is a terrible sector and industrials in the US hasn't done very well, and consumer is okay, but a lot of that growth is coming from overseas, not from the developed markets themselves. But tech is a great way to get growth, so I'll just put my portfolio in that. And so I think that one thing that's going to happen post-COVID is that people will sorry, my computer almost ran out of batteries there, and I just didn't want to lose you all.
I'm allowed to run out.
It's all sorted. One thing that's going to happen post-COVID is that people are going to realize that growth in developed markets is very scarce. And I think you and I have talked about it before, the sort of Japanification of developed markets. Yeah. So Japan, has had no growth for 20 years, and they've had QE for 20 years, and they've had massively expansive fiscal policy for 20 years, and it's still not growing. And so I think that there's a risk that COVID has accelerated the Japanification of countries like the US and countries in Europe and even Australia and New Zealand. And once people start to realize, wow, there's not really any growth, like meaningful growth to be had in these countries, I need to look elsewhere for structural growth stories. that is the point where money will flow out of DM into EM, and part of that valuation differential will close. And then the second thing is, and I know this is controversial, we talked about it earlier this week, is that people often say emerging markets trade at a discount because they're riskier. And those risks are often cited as political risk and currency risk and the risk of civil unrest and like you name it, those kinds of risks that are associated with emerging markets. But part of my frustration in the current time, and also since Brexit and since the sort of European crisis a number of years ago, is that if you actually look at a lot of developed markets, they are way riskier than emerging markets. They're way riskier than some of the more stable markets in Asia. So, I mean, just like log into CNN on any given day and you'll see civil unrest in America. You have an election coming up that's, potentially inconclusive. You have a president who says, even if I lose, I may not leave. You have a massive epidemic which has been mishandled in America. And all these, you have the US dollar, which is in free fall. You have very high deficits. You have, monetary policy was already at the zero bound. If these things were happening in an emerging market, it would be down 30–40%. And yet it's happening in the US, and US markets are at an all-time high. So I think, and then Europe, this was my previous gripe before COVID, was that if you look at the risk in Europe, I mean, you had countries like Greece and Italy and Portugal and Spain. They were like a lot of risk there. And then you have Brexit, and there's like an existential risk to the European Union. And none of this stuff gets priced in the way it would in an emerging market. And so my hope is that, the longer that this goes on, where the sort of risk differential between emerging markets and developed markets is all sort of muddled and gray, that risk, the risk premium or the risk discount that's put on emerging markets will eventually go away, and those will converge. Sorry, Paul, I think you're just you're on mute, so I can't hear you.
Sorry, Mary, there's technology letting me down. That's going to be the next question. We've seen this tremendous acceleration of digitization during COVID. Can you give me a few examples of how potentially you've been able to access this investment theme?
Yeah, absolutely. So the fund has actually performed quite well during COVID. And one of the reasons was, COVID started in China in very late January. So people in Australia didn't start worrying about it until, late February, early March. But we had actually been, really focused on it since late January. And in late January, when, we started to realize that this was SARS or even SARS plus in terms of the magnitude and the implications, we broke the portfolio into 3 different buckets. One was companies that were directly impacted by COVID and lockdowns. We only had one company that was in that bucket. It was called LGH&H. It's a company that gets a lot of its sales from duty free. So we realized no one's going to be traveling, and we sold that. The second bucket was just companies that were high beta and had gone up a lot. If you remember, January and December were actually very strong months in Asian markets because that phase 1 of the trade deal had been signed. And so we looked at a lot of companies that had gone up 30–40% in 2 months, and we just took profits in them. And then the third bucket was companies which will actually potentially benefit from a COVID type environment, and an environment where there's a lot of people in lockdown. And there was like at least a third to maybe even half of our portfolio that landed in that bucket. So these are companies like, Tencent is a good example. There were certain days during the lockdowns in China where there's like 400 million people playing certain Tencent games at any given time, which is just a sort of mind-blowing number. Alibaba and JD, in terms of e-commerce, I mean, that's not difficult to figure out that if people are at home, they're going to be using e-commerce much more readily. Meituan, which is a company we own, it's kind of like the Uber Eats of China. We increased our position in Meituan. Elsewhere, not sort of in that internet-y part of technology, but there's companies like Luxshare. So Luxshare makes the AirPods for iPhones. And I'm sure a number of the calls and Zooms that you go on now, a lot of people have their earphones in so that you can't hear all the background noise. So you're thinking, okay, well, that's a possibility. Samsung, because a lot of people, need phones because they're working at home and that's their new sort of desktop. So Naver, which is a company which is kind of like the Google and Tencent of Korea. So there's a lot of those kind of companies that were in the portfolio, and we either kept them and or increased their weighting. The other thing I'll say is that in India, we had a number of companies also. One is Infosys, and TCS is another company which we own, not in Ellerston Asia, but in the India fund. So these are big IT services companies. And for many years, they've been talking about digitization, and that's where their incremental revenue growth is coming from. But it has just sort of been supercharged recently because now, instead of digitization being a 10-year project that big global MNCs are working on, it's we have to have it done by next week because 50% of our employees are at home. So I think either keeping the portfolio and increasing position sizes in those companies that benefit from digitization, that's been a big source of alpha generation and absolute return generation for our fund.
Ruby, specifically focusing on the Ellerston Asia Investments portfolio, would you mind spending a few minutes talking about some of the larger positions in the fund? I'll bring up the screen for you, Mary, that has those listed.
Okay. Okay, great. So before I answer the specific question, I'll just remind people sort of some of the key attributes of this fund. So first of all, we are growth, as we've discussed. Only companies that meet our growth hurdles can get into the portfolio. The second thing is that we are a concentrated fund. So I can only have 20 to 50 stocks at any given time. Right now I have 29. So this is not there's over 10,000 listed stocks in Asia. This is not, we're going to go out there and buy 200 of them and charge people a management fee. This is a very, very curated stock picking portfolio. The third thing I'll say is that we are benchmark independent. So that means there's nothing in the PDS or in the terms of the fund that says, I have to have X% in this country and X% in this country, and I can't be too much overweight this or underweight this. I have, complete discretion in terms of the countries and the stocks and the sectors in which I invest. So with that as background, I'll just highlight the charts on the left-hand side first. I mentioned the thing about unfettered allocation to different countries, because if there are countries that we don't like, I can have zero allocation to them. So for example, right now we have no stocks in Indonesia, none in Thailand, none in Malaysia, none in Indonesia. We have one Singapore bank, which is where that ASEAN comes from. And so that is very different than a lot of our competitors whose mandates say, if Philippines is 3% of the benchmark, you have to have a 3% or some percent in Philippines, and you just pick the best stock there. If I don't like certain countries or certain sectors, like we have nothing in telecom, we have nothing in utilities, we have, there's whole sectors where there's no allocation at all. And that is quite helpful because it's a different way of looking at investing in Asia. It's not this is what's available to me and I'll pick the best stock in each country and sector. It's I just want the best stuff in the portfolio regardless of what country or sector it's in. With respect to sectors, we do have three core sectors: financials, consumer, and technology. And so this means at any given time, it's 80% plus of the portfolio is in those three sectors. So it's very focused on new economy companies. And one thing which I don't think is in the slides that we have here are that this fund is very focused on ESG, and it has been since inception. And the focus on ESG is not to be trendy or it's become a cool thing in Australia. It's because it can really help manage your risk. And so because we have very strict ESG criteria, that means we don't have exposure to coal companies, and we don't have exposure to energy companies, and we don't have exposure to material companies or a lot of the companies which create a lot of problems for ESG. And that is quite helpful in this environment because it's the new economy companies which are significantly outperforming. So with that long intro, I will get to your actual question, which is to talk about the major positions. So you can see there that Alibaba, Tencent, Samsung, and TSMC, which we refer to as STAT, that's our little FANG-like acronym, they are major parts of the portfolio. And as I mentioned before, you can see that it's not, oh, we like Alibaba, let's put it in a 3% position. We like Alibaba, let's put it in at, actually the highest it's been is around 13%. So these are very big, concentrated and high conviction bets on some of these companies. So you have sort of the big four tech companies in Asia at the top there. And then Ping An Insurance. Ping An Insurance is one of my favorite stocks in Asia because it's trading at 8 times PE, but it's actually a technology company. It sells insurance, but they have over 400 million registered internet users, and they have a whole system of using technology to cross-sell their banking and insurance products and provide health advice and a lot of healthcare products to their customers. So when I look at it, I think, okay, it's basically a technology company that's trading at insurance company multiples. I'm happy to own that. Hong Kong Exchange is also a very big position. And that is for the reason that we discussed before in the context of your question about geopolitics, that when all these ADRs relist in Hong Kong. And one thing I didn't mention in your question about geopolitics, some people think that, Hong Kong is going down because China's sort of taken over and this is going to be very negative. We've heard actually the opposite on the ground, and that China wants to make sure that Hong Kong is super, super successful, to show the world that when we're in charge, things don't go down, things can thrive. And so we expect a bond connect and a lot of more connectivity between China and Hong Kong. And Hong Kong Exchange is the monopoly financial exchange provider in Hong Kong, is going to be a beneficiary of that. Hindustan Unilever is Unilever's business in India. And this is one of the few stocks we have a lot of conviction on in India right now, because it produces staples, so it's soap and food products and shampoos and stuff like that, which people are going to use regardless of COVID or not. And the second thematic that we are looking at in India is, not unlike many countries, including Australia, rural India is doing much better than urban India during COVID. And Hindustan Unilever has a very high proportion of its sales come from rural India. So that's why we feel comfortable with this kind of stock, even though COVID is doing some damage to the Indian economy. China Merchants Bank, as I mentioned previously, this is the only Chinese bank that we own. China Merchants Bank does actually meet our growth criteria. It's growing around 12% EPS growth. And it's trading just above book value, and it's an exposure to a sector which we wouldn't otherwise have exposure to. Hynix is similar to Samsung. It's a technology company in Korea, and then Infosys is the Indian IT company, which is a beneficiary of the digitization. So if you add all those up, it's around 47% of the portfolio in the top 10, and that's what I was highlighting before about being really concentrated, and we want to give our investors, concentrated and dedicated exposure to the stocks in Asia that we think offer the best risk reward.
Congratulations on your recent performance, Mary. You've certainly outperformed the benchmark. Has it been those technology stocks that have been the major driver of that outperformance?
So yes, they have. They've certainly helped. But I'll be honest with you, EAI has been going for over 5 years now. And in the first few years, I noticed a strange thing. It was that those big technology companies were by far the biggest contributors to our absolute returns, but they weren't contributing anything to our relative returns. And the reason, this was in the first 2 years of EAI's life. And the reason was because these are all really big weights in the benchmark. So, those 4 companies combined are about 20% of the benchmark. So if Tencent is a 7% weight in the benchmark, and you have a 7.5% weight in the stock, that sounds like a lot, right? 7.5 weight is a very big weight. But you're not going to make, even if Tencent goes up 30%, you're not making much alpha on that 50 basis points of overweight. And so this is part of the reason why now, if we like these big stocks, I have very big overweight positions in them, because I'm not just, trying to generate absolute returns. I want to generate alpha from owning these ones. So yes, the big 4 technology companies have been contributors to alpha. And then there's other stocks, Hong Kong Exchange is also in the top 5 of our contributors to alpha in the last year. And that's because, to be honest, I don't even know what its weight is in the benchmark. It's pretty small, something less than 1%. And we've had, consistently 5 to 6.5% weight in that stock. And it's more than doubled in the last 18 months. So those sort of very big, high convection investments that don't have a big weight in the benchmark have also been helpful. MediaTek is another company which my colleague Freddie Ho covers. It's a technology company in Taiwan. It's also doubled, and it's, when we started it, I don't even know if it was in the benchmark. But these sort of stocks where we identify before the thematic really takes off, those have been helpful in contributing to our alpha.
And one last question, Mary. You made it clear before that you're with the Ellerston Asia investment pursuing growth. Yep. But, we've also spoken about the desire, particularly from our investors, for income, so for dividends and for reliable dividends. And we're currently in an environment, as I'm sure you're no doubt aware, that many people and many companies are cutting their dividends. You mind talking a little bit about the Ellerston Asia Investments dividend policy?
Yeah, I'd love to, because this is something, we had a board meeting a few weeks ago. This is something which we are really focusing on. As you say, a lot of the traditional, dividend providers in Australia, that dividend is either been cut or it's, uncertain. And so we recognize that this is something that's important to our investors. So the first point I'll make is that because all the companies that we invest in are growth companies, in general, they don't have a big dividend payout themselves because they're in growth phase, and whatever internal cash that they generate generally gets plowed back into the company and its growth. So this is not a dividend pass-through sort of vehicle like a lot of Australian LICs are, where they get big dividends from the banks and then they just pass those on to investors. The way that we generate a dividend profit reserve and the franking credits to pay 100% fully franked dividends is by our stocks going up, and then we realize those gains and we pay the tax on that, and that's how we get the franking credits. So if you recall, for those of your clients who have been invested in EAI since the beginning, for almost the first 2+ years, we didn't pay any dividend at all. And that's because it takes time for those stocks to go up, and then it takes time to build up that dividend profit reserve. And right from the beginning, the board didn't want to say, we did have funds available to pay a dividend, but they didn't want to say, okay, we're paying you a dividend this year, but we have no idea if we can pay you one next year or the year after that. So the idea was to build up a dividend profit reserve so we could pay a sustainable dividend with multiple years of profit reserve to give our investors some sort of certainty in terms of this year and also coming years, what they should expect. So the first 2 dividends that we paid, one interim and one final, were both 1 cent. And then the next 2 dividends that we paid were both 1.5 cents. And then the most recent dividend, which we just announced is last week or the week before, is actually 2.5 cents. That is a big increase in terms of the semi-annual dividend from 1.5 to 2.5. And at the end of June, the dividend profit reserve was 8.5 cents. So if you take the 2.5 cents off the 8.5, we still have a decent amount of fully franked dividend profit reserve to continue to pay a sustainable dividend for years to come. So that's sort of how we've approached the dividend, and we hope that our investors are happy, but we're happy to take feedback in terms of what people think of our dividend policy.
Fantastic. Mary, as always, I could listen to you talk about Asia forever. Your insights are very much appreciated, and your availability is very much appreciated. So thanks for your time today. Stay well, and we really appreciate you putting the time into doing this webinar for our clients.
Great. Thank you so much. I really appreciate it, and hope everybody stays well. Hope to see you again soon.
Thanks, Mary.
Okay. Thank you.